In the US, there was a great model called venture economics, and it was owned by a rather interesting but strange guy. What it did was it handled conferences that attracted investors to various themes. And that gave a platform for the managers in the US to talk to the investors and raise money or not raise money, tell them their strategies. And we thought, why not do a venture economics in Asia to present the industry to investors and talk about their concerns and what they want to have as risk control, what should be the management strategies, and is anybody interested? So we contacted venture economics, and they had no interest. So I was a venture capitalist, and I had some friends in the industry like Victor Fung and Rao and others. And I got them together around the idea of starting the Asian Venture Capital Journal. And so, in effect, the industry itself started the Asian Venture Capital Journal.
The first investment we made was in 1984 when I flew to Tokyo with Peter Brook, whom we had invested in previously after he had formed TA Associates in Boston, but he formed Advent International in 1984. His pattern was to get together with a very successful businessman in different countries around the world and combine Peter's experience in successful U.S. venture capital investing with a local businessman's knowledge of the markets and of the country. So in Japan, he teamed up with a gentleman by the name of Yaechi Ayakawa, who happened to be an MIT graduate, very well respected in Tokyo. And together, Peter and Yaechi Ayakawa formed what was called the Advent Techno Venture in Tokyo. 2 years later, Peter came back with the idea of forming a fund in Hong Kong, and it was to be called the Hong Kong Investment Trust. And he teamed up there, the local businessman he teamed up with there was Victor Fung. And that was our second investment. And then subsequent to that, we made investments with Louis Rutherfurd, with Louis Bowen, Anil Tadani, Bob Thaleen, and a number of other people in the Asian market as we were gaining our experience during the 80s.
The investors thought that Asia would theoretically be a good place for them to invest through this model, through the venture model. And they felt that the demographics of Asia were excellent and would lead to higher returns than the venture industry was experiencing as of that time in the States. The returns happened to be very good in the States at that time. So the level was raised quite high from the beginning. And most of us failed to achieve that level of anticipation or expectation. Some of us, in all modesty will say myself, did funds that exceeded the US, and we also did funds that were basically lower than the States. And a lot of venture funds did not exceed the expectations, and some, as it turned out, missed the ball entirely and found that the model of investing was not suitable to certain industries or certain countries. So everybody, for a number of years, asked the question, why?
The early investments in Asia, not just ours, but everybody's investments in Asia in those early days, I would say generally were not very successful. As is true in any new markets, there wasn't a lot of experience. There weren't entrepreneurs who had done it before. There weren't venture capitalists who had done it before. There weren't track records to look at to make judgments about who you would invest in. Other things that are critical to success in venture capital that were present in the United States were not present over there, such as stable governments, stable currencies, IPO markets, exit mechanisms. Those early investments were, I would say, discouraging, but they're a way for everybody to learn in the industry. We assume that we, as the investors and the entrepreneurs, were on the same page. And as I say, those early days were really venture-type investing, where we and the partnerships that we were invested through did not have control of the companies, unlike the later models when the buyout business came in and control was in the hands of the investors. In the early days, the control was in the hands of the entrepreneurs. And therefore, the experience of the investors, of the venture capital fund managers, while it was very important, they weren't able to exercise perhaps as much control as they might have liked to, and as we became used to in the U.S. in the venture capital model. This is a little bit of a biased point of view, but I think many of the early entrepreneurs looked at the equity that came from the venture capital firms almost like debt, and didn't really think of us as partners.
Yeah, so I started at H&Q right out of business school and had every plan to work in Silicon Valley doing tech investing. But it happens that the managing general partner of H&Q Venture Partners was a guy named Ta-Lin Su, who was building a private equity business in Asia. And in those days, you do whatever your boss tells you to do. So I found myself on a plane to Taipei in the fall of 1988. And that's when I first started working on Asian deals. I think the first iteration of private equity in Asia, and this was pretty close to the beginning of it, was a version of venture capital. And the markets at that time were, there's plenty of capital for venture deals within families, individuals, companies that were sponsoring other venture-backed deals. What was missing in the market at the time was a so-called, first institutional round capital. So the typical case was a company in Taiwan or the Philippines or Singapore that was entrepreneur-owned and was looking to bring in capital in anticipation of an IPO. And most of the local markets required there be some outside investor to validate, in effect, that the books were accurate, that another professional investor had looked at the company and had decided to invest. And I think that's kind of how the business got started. And in the case of H&Q, the market timing was really excellent because they started in 1986 when the market really took off, and there were a bunch of very, very strong tech deals. Companies like Acer, TSMC, UMC were all early deals that were done by the venture community in Taiwan, and I think it took off from there.
I started off in this region, in VC. So I joined the industry around 95, 96. I think it's technically 95, when I joined Nikko Capital. So this was the time in the 90s when the capital, or venture capital as we call it, was pretty much dominated by Americans, European, and Japanese. So I was actually with a Japanese VC at that time for about 3 years. And we didn't survive the crisis. At that time, there was no buyout to talk about, right? There's literally no controlled transactions. There was some who tried to do that. I think HSBC, George Rafini were trying to do some buyout, Parma. Some of them were trying to do buyout, but effectively, what was very common, there are three types I would call it. One is pre-IPO type investments. One is what I would call venture-ish, dominated by largely Taiwan at the time. This is the time of the PC peripherals and hardware, storage technology. So Taiwan, because of the link to the US and the emergence of Taiwan and Korea. So VC is somewhat largely dominated by Taiwan, pre-IPO basically across Asia, largely in Southeast Asia, because the emerging market, I call it the first emerging market bubble. The stock market was very vibrant. I think from 93 on, 92, 93 onwards, Southeast Asia, so talking about Indonesia, Philippines, Thailand, Malaysia. It was very hot. IPO market was very, very hot, and so pre-IPO was very popular, and broadly defined infrastructure. So there were some infrastructure type deal where private investors participating through private equity venture capital structure. So I would say pre-crisis, these are the kind of deals at least we were looking at.
Newbridge the first thing in 1998, and I made my decision on October 23rd of 1997 as I was walking in Times Square with my wife, and I saw the Hang Seng Index dropped 1,000 points at that particular moment. For the day, it dropped 16%. So I turned to my wife and I said, well, this is time to get out of sell side to get into buy side. So it was in the middle of 1997-98 Asia financial crisis, and that was the market, that was the environment.
So I think what the crisis did is that it basically put in place a much more, well, in theory, the capital structure became much clearer. What kind of risk are taking, and the industry was effectively wiped out. The capital came from, as I mentioned, predominantly foreign capital. There was some participation by local family offices and all, including some in Hong Kong and some sovereign wealth funds. But predominantly those investing in Asia tends to be from US, Europe, Japan, as I mentioned. And those capital dried up overnight because the crisis was, people forgot, there was change in government in most of the country where recession hit. Korea, Taiwan, Indonesia, Thailand, Philippines all have a change of government. Malaysia barely survived because of the exchange control. Even Singapore was impacted. So I think the change was very dramatic. It basically, if I look at the private equity industry today in Asia, I think it started in probably the ruin of Asian financial crisis in 1999-2000.
I think the Asian financial crisis was the key turning point in the industry. I think it's the first time that fund investors were really able to buy control of large businesses, mostly because so many businesses had been nationalized by governments in Korea, Indonesia, and Thailand. And there was a brief moment in time when the most powerful investors in the region, families, chaebols, corporate groups in Japan, were so heavily levered, they actually couldn't buy assets. So I think it created this moment in time when corporate sellers and even governments were willing to sell to funds, which was a pretty outrageous concept at the time, because I think the idea was a fund is only around for 10 years, ownership of a company is forever. So I think Korea First Bank was certainly one of the early deals that created the foundation for the industry to take off, mostly because it proved that a private equity owner could not only put up capital, but could actually help turn around and even build a business.
Newbridge Capital was set up as a China fund, so we're supposed to invest in China. But as you probably remember at that time, asset prices collapsed all over Asia but China, because China was rather closed. So the best opportunities became outside of China, and Korea was more severely hit by the crisis than anywhere else. So it was quite natural for us to look at Korea. But honestly, the opportunity was presented to us by the sell side. And we were in the process of raising the second fund, which would become a $400 million fund. Korea First Bank required $500 million from us. The Korean government put up with the other half of the capital. So we could put in no more than, say, $90 million. The fund size, eventually we raised our second fund, was about $450 million. So we put in about $90 million, about 20% of the fund. But we needed $500 million. We raised the rest of the money in a few weeks to close the transaction. So it was actually pretty bold to sign up a deal without having fully lined up the capital. But my thinking was, if the deal is good enough, there's no capital constraint.
When I started in 1998 in private equity, this was at the height of the Asia financial crisis. The private equity industry and buyouts in particular were basically a thesis to be proved. I think there was a little bit of venture capital before that, but Western style private equity really took hold with the Asia financial crisis. With my former employer, we did one of the first large buyouts. It was a buyout of the distressed bank in Korea called Korean Bank. Newbridge, as they were called at the time, did something similar right before us of Korea First Bank. The two of us went in, put in a big amount of fresh capital, recapitalized, and turned around the banks. Those banks in turn provided much needed liquidity, credit liquidity, to industry in Korea. So I think those two deals were landmark deals that both highlighted the Asia financial crisis, but ushered in a new era of Western style buyouts in Asia.
So when I joined predecessor of Adam Shi, which was UBS Brinson in '99, when we first looked at Asia, we didn't want to look at some of the venture stuff. So the focus was in buyout. But prior to '99, most of the buyout transactions were disaster. There's a group called NBO Partners. They've been around since the early '90s, trying to do buyouts. Really struggled. Parma was trying to buy out. I think a very famous case was the buyout of Delifrance, the cafeteria chain, which was a disaster. So the few case studies that we could gather at that time raised the question of whether the whole idea of a financial investor taking controlling position and running a company, whether that strategy can work in Asia. The idea was that it's so dominated by families and state capital that maybe there's no role for buyout. The first few deals that really caught investors' attention was some of the restructuring deal in Korea. Camco was one of the most aggressive. Obviously, if I look back at that time, the chaebol obviously broke up, and so there was a huge the series of Mundo transactions was significant. Some of the bank restructuring, Shinsei Bank in Japan, Korea First Bank in Korea, those caught investors' attention. Here in Hong Kong, I think it was ASAT, a semiconductor testing and chip company that was bought by, that time was Chase, now CCMP. But those were all deals, we look back, came out of the restructuring agency, the bank restructuring agency. So when we first look at the market, we question the sustainability of that model, because in the past it didn't seem to work for various reasons, and there was a period of time where we start seeing huge transactions and participation from global buyout players. But these are all government bank restructuring agency managed deal. So the question is that is there a sustainable pipeline when the restructuring is done?
And you establish a reputation for being able to do it, and you build a little profile, brand, reputation for Newbridge Capital, then it became a little easier. Honestly, if we had not done Korea First Bank, we wouldn't have done Shenzhen Development Bank, which happened a few years later.
Raising capital was difficult because investors were not yet completely bought into the idea of China, and I think that really was ultimately the spark that really drove large capital pools into this part of the world. So there was skepticism about that. There was, frankly, a little bit of skepticism about what was the right model going to be. Was it going to be venture capital, growth equity, controlled deals, of which there were very few? And I think a lot of limited partners, particularly the larger limited partners in North America, who were familiar with the model in the U.S., were looking for what model would work in Asia. And I think it took time for that to really develop. Again, I think the Asian financial crisis was the initial spark for that. So we went from a $100 million fund to a $320 million fund to a $720 million fund in the wake of the Korea First Bank deal. And I think from there on, it was really returns rather than the promise of the market that really drove fund size. So from there it was $1.5 billion and then $4 billion, and then that's when the business really reached maturity.
Well, the late 90s were fairly quiet, to be honest, in our area. And we were still at a phase when there weren't any private businesses to invest in. We actually created a couple of private businesses. In China, we also joint ventured with state-owned enterprises, which was not a great lucrative way to proceed. So it was actually a tough time. Things just started bubbling again around the late 90s, I think, where we started to see people coming in, replicating U.S. business models in China for the first time. And that's where, I met first Xiao, who started EachNet, who came to see us, I think it was like 99 or 2000. And I'd been living in Shanghai. And so it was a revelation to me what was going on in terms of eBay. I didn't really know about eBay. I lived in China where we were battling it out with Sino-foreign equity joint ventures, principal form of investment. So the activity outside of any kind of collaboration with state enterprises was fairly new. But once that took off, all kinds of things started happening.
So when I first got started in venture capital, it was because of a relationship I had in Japan. In the late 1980s, I met Masayoshi Son from SoftBank, and we became friends. Then in 1995, when he was setting up SoftBank's operations in the US in a more formal way, he had the idea of running a venture capital firm. So we played a round of golf, and after the round of golf, I went to his room, and his room was filled with spreadsheets on his 100-year plan for SoftBank, and part of that plan was a venture capital fund. So during the course of that discussion, he asked me if I was interested in running that, and November 1995 is when I became a venture capitalist. So in '99, I came to China and helped Shangzhi Xie set up SoftBank China Venture Capital. And that was SoftBank's corporate money. That it wasn't a fund, it was just money from SoftBank corporate that Shangzhi was deploying. Then in 2000, right around the time that the crash was happening, so I had created a joint venture for Cisco Japan when I was at Cisco. Now I'm on the SoftBank side. So Cisco bought SoftBank out of its position in the joint venture. Part of that buyout was a commitment of $650 million to a fund called the SoftBank Asia Infrastructure Fund, or SAFE Partners. So for the first year I ran SAFE and hired Andy Yan in 2001 to come in and run that on a formal basis. So that was right at the beginning of what I'd call the institutionalization of venture capital in China.
The first fund was 100 million. And the old asset we managed at the CICC and turned over. Some investors decided to take their investment not to roll over. The one that we roll over is about 65 million. So we got about 165 million AUM to begin with. Their institutional backing, the primarily for institutional investors at the beginning, and GIC was the one behind it, and the GIC have a strategic view. Probably that was one of the reasons they get into CICC to begin with. So they were continuing to supporting us to help us to swing off as an anchor investor for our fund and the small shareholder of the general partner. And then Capital Z, which was the Zurich insurance sponsor business fund of funds. So they were there. UpInvest was early investor when we were at the CICC, and so they were very happy with the early investment with us. They were anchoring our fund, and IFC being a financial, development institution, and seeing that emerging China private equity market, and they were early supporter. At the beginning, we were at the right time for private business in China. They were at an early stage, but they have on a very fast growth track. This is particular true in the consumer brand related business. So if you look at our early investment, Mengniu, Lavine, Fox Media, and later on Shuanghui, Baili, and there are 15, 20 of them. Later on, when we invest, they were small and valued at a few $100 million, maybe less than $1 billion valuation. Now they are all multi-billion-dollar businesses. We continue to evolve in their growth in several rounds later round of investment. Now some of them are big enough to get into global M&A, that's later. The current, if you look for the first 5 years, is primarily financing their growth and help them into a structure so they can list it in international stock exchange in Hong Kong or in US.
We helped launch Fengbo at the fund Seiyuan. He and his brother had done New Margin with Eric Neil Lee before. And then in 2005 is when I moved to China, because that's when it became quite obvious that the institutionalization was going to occur, and the opportunity China represented was roughly the equivalent of what the US represented. And it was the first time there was another market where you could legitimately look and say, not just in one sector, but across very many sectors, the China market would be roughly the equivalent of the US for venture capital. I would say that two things happened. One was when some of the major US firms came into the market. So you had NEA combining with Greylock to do Northern Light. You had Sequoia hiring Neil Shen. Andy had grown the SAFE platform into something. IDG had started to expand. And you had a couple IPOs. So you had Tencent in the market, even though the market cap was relatively low. You had Baidu in the market. Sina had gone public. Alibaba had not, but the Taobao launch had drawn everyone's attention into what was happening with the potential electronic commerce in China. And people started to realize that China was going to bypass fixed line infrastructure and the entire country was going to be built on mobile. So that was the first wave. And that's when you also had the Princetons, some of the other major institutional investors come to China in a meaningful way in 2005, 2006. 2007 and 8, it was more just the basic building blocks of the industry and the infrastructure. Then in 2009 and 10, the RMB funds started to launch. So that created a domestic pool of capital because the listing requirements had been relaxed for quite a few companies. And you had the second board, you had the Shenzhen board, you had the China Exchange. So you suddenly had liquidity within domestic currency. So coming out of that, the 2010-11 timeframe is where you really had an explosion of China's venture capital industry really moving onto the world stage at a large scale. To the extent now, China does as much in a quarter as Europe does in a year.
Well, we certainly didn't think that could grow this big 15 years ago. I think Jiaozhen and I was talking when we first spin off. We were talking about our ultimate size was 1 billion. That was the dream or the plan then. We were surprised or very happily see that China private equity has grown so big. I think there are reasons if we look at it, backward today. China primarily funded their economic growth by debt, indirect financing. There was lack of equity financing in various of the business growth. This is particularly true for private businesses because the bank like state-owned enterprise because that's safer. And the capital market developed in China has been constrained with various things. The IPO wasn't really completely market-based, so they're on and off. So that was it's not very reliable. So there's a need for equity. If IPO market doesn't provide sufficient equity, the private equity come in to fill the gap.
We stayed out of China for quite a few years because, again, asset prices outside of China were cheaper than in China. And then, after 2000, we went back to China market. China has come a long way because at that time, there were not many big deals, not many buyout deals. But now, China market, I feel, has much more matured.
Bill and I had been both active in this area since the early 70s. He came back from Harvard and set up a small fund which basically did seed and expansion capital, and that was a number of high net worth families. I joined an industrialist who was a Hungarian, and every Hungarian with a good business idea in Sydney was hitting on him to say, I've got this great idea, will you fund it? So I ended up joining him, and that was my first job out of uni, really riding shotgun on deals that he sort of authorised, and then gradually I became involved in seeding them as well. And we ended up doing seed, expansion and MBO. We did a couple of MBOs in the 70s as well. So by the mid-80s, Bill and I started talking about that there was probably enough evidence that you could do deals across that whole range of investments, and that we could get some institutions interested in getting the first institutionally funded private equity fund up in Australia. And so we started that in mid-87, and of course the stock market crash came sort of in October of that year, and we thought that was the end of that. But interestingly, the investors got it, that without a capital market available for companies wanting to expand and raise capital, a private equity fund would actually be better positioned post the crash than in the boom time ahead of the crash, when you could raise money easily on the stock market. So in fact it turned out to be a silver lining, and we got our first fund, a $30 million fund, away in 1987. And I'll remember to this day people querying us whether 30 million was far too much. Would you be able to invest it? It was really a couple of years before another fully institutionally funded, rather than the private net worth fund got going. And then it really sort of got going. I guess the momentum really built up in the 90s.
So it was a firm set up. Effectively, around the sort of hypothesis that there was a gap in the market for mid-market buyout. So, I mean, historically in Australia, PE had been sort of these small pools of a generalist funds, so people would do everything from VC, growth capital, baby buyouts. There was sort of no sort of core investment focus. As long as it wasn't listed, then they'd do it. We said, look, there's this opportunity to actually focus on sort of acquiring companies 100% with enterprise values sort of north of $100 million. And so that was the proposition we put to the market. The market, while they kind of thought it was attractive, we were seeking $200 million, we ended up getting 101.3, of which that last sort of 20 odd was friends and family. So we weren't really capitalised, but what it did mean was we had to then put a lot of other people in, like AMP, to club on these deals. And so actually what we found was we kind of formed a community of guys who are now focused on doing buyouts in that, at the time, obscenely high price range of more than $100 million. So kind of that first couple of years was as much about establishing the buyout market in Australia in a sort of more of a pure form.
The origins of our business were that we spent as a team 20 years in consulting. So this is working for third parties looking to add value. And our experience was extraordinarily encouraging. We saw total shareholder returns increase across the portfolio by 42% per annum. And so the question on our minds was always, could we do that in a different format to capture value in a different way and have a more successful line of sight or more compelling line of sight on how to change businesses? Private equity is the obvious alternative. There were a number of enterprises that would now today be described as captive funds. So there were a few large institutions with funds that were investing in businesses, but there was nothing that was classic, standalone, leverage buyout, private equity. And so to establish that, we had to go, in fact, offshore to get the technology from the US, where we had to bring in the types of contracts and understandings that were already established in that market that were involved in the accounting firms and the legal firms over there, and bring that technology into Australia. And so it really literally was starting from ground zero.
The idea sort of germinated, we thought about it, and then looked at the market regulatory environment, and there was a regulatory restriction, a pretty big one. That was majority ownership was prohibited by financial sponsors, and board participation. And so while we started with the idea, it was 5 years from there to that regulatory change actually taking place before we could start the first fund. In the aftermath of the bubble, there was a lot of deregulation, financial reform, things that were happening. And this restriction on financial ownership, majority financial ownership, was on the docket to be changed. And when it did, so we had the plan and the idea, waiting for that to happen. When it did happen, we were sort of first guys out in the market to say, let's go do this. There was clearly a need because of the banking sector in Japan that had long been sort of providing basically free capital to all sorts of segments in the economy, was unable to continue to provide the same level of capital they had been because of the consolidation, the restructuring, the NPL problems that we had in Japan back at the time. The bank balance sheets were very weak, and there was consolidation happening in the banking sector, which meant bank capital was not as readily available as it had been. And so, yes, the people that fill that pinch are medium, small companies that are now looking for alternative sources of funding, and they're also faced with succession issues, which began emerging even back then as part of this. So an alternative sort of sponsor emerging was, welcome in some sense. And the needs in terms of demographic changes with founder owners and the changing in the banking sector availability sort of dovetailed into the start of the first fund.
We closed Tasman Building Products on the 6th of April 1998. There was 155 million Australian enterprise value, so that was the largest deal that had been done in Australia for more than a decade. and it was a very successful deal, so it's sort of about 4.5 times your money, and it really carried that fund and just presented so much momentum as to, well, look, here's the case study, it can actually be done. Now, if you provide us with more capital, we can continue to do these types of deals.
This company called iCreo was actually a subsidiary of Wyeth Corporation, a large multinational firm, and it was a baby formula, baby powdered milk Japan business. But that was one where sort of all the pieces of a leveraged buyout, even though it was a small company, we were able to get some debt, we were able to sort of have a proprietary discussion of carving out a subsidiary of a large corporation, affect some management change, and sort of all the elements of sort of leverage, financial sort of profit improvement, and multiple appreciation, sort of the three things that you build into private equity returns, all came about to really make that work. And it was also it was less than a 3-year period from investment to exit, so it all happened very nicely and very quickly, and it really was sort of the first true leverage buyout model that we did.
And thinking back now to our first deal, which was Frucor, it was a purchase from the Apple and Pear Marketing Cooperative, I think in New Zealand at the time, and it was a beverage company. And so it was classic. It was the sort of deal that later on became very familiar to us, but it was our first deal. We're fortunate that it became a 10 times the money deal, a little under 10 times the money. But the journey took us through all the different stages of buying the business, enhancing the profits, trading a portion of it, included IPOs and other things along the way. So very complete journey and a very exciting journey for us.
I think the first time you'd say the proposition was established was probably the mid-2000s. So, between us raising our first 2 funds, PEP entered the market, Champ moved from being a growth capital fund to a buyout fund. They did the deal with Castle Harlan. Quadrant were moving more up into that space. So it wasn't until Catalyst was raising bigger funds. So it wasn't until sort of mid-2000s that, in a sort of Michael Porter sense, you had a cluster forming an industry. And of course that then creates its own ecosystem of advisors. So deal flow increases exponentially because, there's a lot of people who can make money off us, charging fees and stuff. So they were out there looking deals for us. The law firms start having guys who are just covering the PE guys. So, you go from kind of, a sole trader almost to kind of a proper industry with some critical mass.
In the early 2000s, before you get to 2007, 2008, is just if you look at all the elements of Japan, second largest economy, now third, but at the time second largest economy in the world, the whole depth and spectrum of industries and sectors and numbers of enterprises, that at least at some level comparisons with the United States in terms of the potential for private equity investment. And nobody expected it to be at the same level in terms of GDP, adjusted investment. But even if it got to some fraction of that, in terms of M&A activity and private equity participation, there would be a substantial market and there should be large deals. I think that underlying premise still holds today, but there have been invariably various hurdles and bottlenecks and maybe other structural things that have not let that develop to that stage that I think the underlying potential points to. I think what we're seeing today is directionally towards the new normal. Certainly we've seen steady increase on the smaller end of the market in terms of founder succession deals and smaller carve-outs. That has continued the last 4 years, I think, steadily growing, and we continue to see very, very good pipeline activity and deals that we're doing there. And then on the larger end of the market, which has been very lumpy and sporadic in the past, a little bit more activity and consistency. It's hard to say that that's going to just continue at that level or continue to grow at that level forever, but certainly the latent supply of potential deals is there. And the question is private equity now really coming into its own in terms of being a viable sponsor for more and more of these deals?
We've been very fortunate in the experience we've had today. We've had a quite clearly segmented market. We've had very clear lanes of business for different players. And we've had very disciplined banking system, which has meant that we haven't seen extraordinary levels of leverage and the risks that come with that. And we've got quite a complex deal sourcing environment. So the combination of complex deal sourcing, disciplined banking, and quite a well represented but not overrepresented market has meant that returns in this market have been very strong. As we look forward, we've seen, if anything, a reduction in competitive tension in the last couple of years, but we're also seeing a morphing of that. We're seeing some of the large Pan-Asian systems which have done deals in this country but have not had a good investment experience in aggregate at all, beginning to experiment with deals in the smaller enterprise value space. And so it'll be interesting to see how that develops. They're obviously great brands. So far, our experience has been they haven't impinged on the more difficult, more complex turnaround and value creation stories that tend to keep the local guys busy. So still we see a very strong segmentation.
Raising capital was difficult because investors were not yet completely bought into the idea of China, and I think that really was ultimately the spark that really drove large capital pools into this part of the world. The second hard part was finding people and finding the right partners and professional teams who were both Western enough to feel comfortable in a firm like Newbridge, which was really had a strong, U.S. roots, to people who were also Asian enough or from the local markets to really understand not only the language but the culture and have a local network. People like that were very rare in the early days of the industry, and there was a sort of a knock in investor circles on hiring bankers. Although most of the best hires and the early people in the industry were folks who had M&A backgrounds at major firms. And then the third very difficult thing was buying control.
Carlyle decided in the mid to late 1990s that we should try to become a global organization. So we decided we would set up a buyout operation in Europe, and then as soon as that was put together, we would go to Asia. So we decided to start in Asia in the late 1990s, and we recruited a team and began to raise a fund in the late 1990s. To the extent that private equity existed, it tended to be a minority stake type of business. It was not a control business. And also the biggest economies then were not that willing to accept private equity. So China was not something we even considered at the time. In the late 1990s, we were focused on Taiwan, Korea, Southeast Asia to a large extent. India was not really in our mindset at that time. So it was a much different business, and it tended to be minority stake. Now, we also had a separate Japan fund, and we were raising that simultaneously with our Asian fund to some extent. So we separated Japan and Asia.
Well, we thought about entering the Asian market at many different points in time. The first time was really in the late 1990s during the Asian financial crisis. But at the time, we had prioritized our expansion to Europe first and spent the next 5 years building out our European platform. We really turned our attention to Asia in earnest in the 2004-2005 timeframe. Asia was obviously booming at that point in time. The macroeconomic growth trends were quite compelling, and we thought that was the right time for us to establish our franchise in the region. The strategy was really built around 3 core pillars. We wanted very localized investment teams to really blend into these markets, hire the best local talent we could, to integrate that local talent into our global platform and deliver a seamless global solution to our clients in the market, and finally to bring to the table a very significant operational capability. At KKR, we call that group our capstone team.
The first opportunities for Bain Capital Credit were probably more than a decade ago, but they were very, very opportunistic. A single investment here, a tech company that had operations somewhere in Asia. And over time, we started doing more and more in Australia. And from Australia, we started expanding out north. And over the past 5 years have really built out our Hong Kong office, have local language speakers. And several years ago, we bought JP Morgan's Special Situations book, what they called their GSOG business, Global Special Opportunities Group, which had a big Asian book. And that sort of jump-started us with people in Hong Kong, as well as exposures in a lot of different countries.
Well, in our Asian buyout fund, our first one, which was hard to raise, I think it was $750 million. It took us many years to get that raised. Many people were skeptical of buyouts in Asia. We did a transaction, China Pacific Life, which turned out to be an extraordinary transaction. We bought a more or less bankrupt Chinese insurance company, life insurance company, and we helped turn it around and made a great deal of money for us and our investors. And as a result of that, we realized that yes, you can make a fair amount of money in Asian private equity.
Well, I think in each of the markets that we've invested in across the region, there have been milestone transactions which really, I think, opened up the market for us. Today, Japan is by far our busiest market for investment, and it's really the large corporate carve-out opportunity that's presenting itself for the first time. And I would say in Japan, the landmark transaction we did in Asia 2, our second fund, was Panasonic Healthcare. It was the first time a really blue-chip parent company like Panasonic decided to partner with us and trust us with one of their large non-core subsidiaries. And we've demonstrated our ability not only to improve the profitability of the business, but to conduct significant cross-border M&A. In our second year of ownership, we bought the Bayer diabetes business in Germany and really doubled the size of that business. In our first 8 years on the ground in Japan, we did one buyout. In Fund 1, that was less than 5% of our capital. In Fund 2, when the market just started to open up, in the last 4 to 5 years, we've done 5 large corporate carve-outs.
I think that there hasn't been a watershed moment in credit where all of a sudden everybody started looking to Asia, although I do think that there has been a natural progression from people were comfortable in the US, then started investing more in Europe. Europe had a very severe couple of crises. There was both the GFC in 2008 and then the sovereign crisis, which went from country to country to country. And as people saw that in some very, very difficult situations, if you're buying assets, if you're buying credit that's very close to the assets, you can make money in a bunch of diverse creditors' rights regimes. That naturally, I think, has led people to look at Asia, which is an enormous market for credit.
I cannot say that I'm surprised that Asian private equity has grown exponentially since we first started, because the Asian economies have been very robust, and China has become the second biggest economy in the world. India is on its way to be one of the third or fourth biggest economies in the world. So really, the private equity world now in Asia reflects what's happening in the overall economies. But it wasn't easy, and many people probably forget the fact that in the late 1990s, people didn't really think that you could do controlled transactions in Asia, or that it would be a very good growth business for private equity firms from the United States coming in and investing there. Now it's a very good business for global firms, very good business for indigenous firms.
When you're building an asset manager in any region, but especially outside your home territory, you need to balance two objectives. One is to transfer the DNA and the intellectual capabilities that have made you successful, and recognizing that there's local customs, skills, and language needs that you need to respect. I think a lot of companies have expanded with an attitude, hi, I'm from New York, you're happy to meet me, and haven't really recognized the local culture and custom. What we try to do at Bain Capital is make sure that when we expand, we have some people who have worked at the firm for a long time go and hire and build an office that is predominantly people from the region. I think that's the best way to respect local customs. It's the best way to develop sourcing networks, and obviously the language skills are critically important.
I think there are really two major constraints to building scale in Asia today. It's a lot of different markets, so it's not one monolithic region today. The cultural differences, the language differences, the political, legal differences across all of these markets are dramatic. So what you're really talking about is building scale in each of the major countries that you want to do business in. So for us, it was really getting scale in terms of human capital, finding great talent, and the pool of talent in Asia within private equity is a lot less developed than the United States, for instance. So finding that really senior experienced investment talent was much harder to do. And then secondarily, once you have the talent in place, really being able to find the great local partners, the great families, the great management teams that you want to back in each of these markets.
Very surprised by how fast the industry developed and how much money has come into the industry in spite of the returns in the 90s, which were particularly bad, and the early 2000s. I think the industry has figured out how to do it much better than the initial 20 years, where people were examining a strategy and it failed, or examining a country or an industry and found that that wasn't the right one. There was a great deal of learning in the 70s, 80s, and 90s. And some of the major learning has happened.
From where we started in '99 on whether private equity makes sense in Asia, to whether buyout is a sustainable industry, whether you can find enough deal flow after restructuring is done, to whether you can get leverage, acquisition finance, to post 2005, no one questioned that. So the whole intermediary network has grown up. There are a lot more evidence of success, landmark deals in the buyout industry across Asia, not just Japan, Australia. You have in Hong Kong, Taiwan, Greater China, Southeast Asia. So I would, if I look back at my first assessment, I think it has exceeded expectation in that sense. Whether the return, so the industry has really grown. Now return is a different question. I think it is arguable whether if you do a buyout deal in Asia, whether you necessarily should be asking for a higher return than if you do one in North America. I think that remains a question.
Well, I think everybody in the industry has been surprised. I mean, even the most optimistic of us, I think, would have to admit that things really ramped up dramatically in the 2000s, possibly more rapidly than the market was capable of absorbing. But that was a real explosion of activity prior to the crisis. There was just a lot of money in the world looking for things to do, a lot of enthusiasm, a lot of exuberance, and fund managers were created very rapidly. That was a surprise. And a lot of money was made, but the dispersion of returns is pretty broad, so not everyone did so well. And I think that what we're seeing now, 10 years later, post-crisis, is some of the chickens are coming home to roost as far as some of the funds that were formed without really careful analysis or careful structuring or the right composition. Sector issues, concerns about exits are becoming very, very prominent now. I mean, Asian private equity is a broad term. I always say, it's a geography, not a market. And so, I think clearly there are, places where people have made significant returns on their capital. And I think private equity plays an outsized role for funding private companies in China. It still does, has significantly over the last 10 years. And there, if you invested wisely or were lucky or a combination of the two, you could have done extremely well. I think that we hold up in terms of the overall performance very well vis-a-vis the US and Europe if you're in the top quartile.
It's become very competitive. And I think the sources of capital have become, the industry has grown up at a time when the capital pouring into the private equity industry has also increased dramatically. So we had a huge increase in fund sizes in Europe and North America in the 2000s, and a big expansion of the limited partnership pool around the world as not only asset allocations among traditional investors increased towards alternative assets, but whole new pools of investors were created. Sovereign wealth funds all over the world, the large Canadian plans. So you had this huge influx of capital at a time when the industry was also was maturing here in Asia and developing local players. And Asia is a very entrepreneurial place, and anyone who's really good and establish themselves as a private equity investor is inclined to go off and set up their own firm. So you have this confluence of regional firms, global firms, local firms, all competing in each of these markets.
If you look at the deal size, it has become much larger than before. And I think if you look at the competition, we were quite lonely at the time in the late 1990s. And now there's a lot of capital, a lot of private equity capital around. So I think that the market has become more familiar with private equity as well. I think it's a process of market selecting the best managers, because I don't believe that the market can have so many competitors. And our business is how much money you make for investors. And I think over time, there will be differentiation. The best managers will stay, and not so good managers probably will have to exit. Although in this business, it takes a long time for somebody to exit.
You have, I think, a thriving private equity industry where we are proving the thesis that you can make money doing buyouts in Asia. The markets in Asia, to be sure, have developed at different rates. In the markets that I operate in North Asia, that is China, Japan, Korea, I think certainly buyouts have been improved, and in those markets, I think private equity in general is a buoyant industry. Certainly the economy, the gravity, center of gravity of the economy has shifted, and with that, with demographics, with rapid corporate expansion, and liquidity in both the credit and equity markets, particularly private equity markets, I think Asia is now a very important market, and certainly is holding its own as the third leg in the US, Western Europe, Asia tripod for private equity.
I think for us, we are very, very happy with the growth of our private equity business in Asia. It is by far the fastest growing part of our global private markets business today. We've reached a scale in Asia with Asia 3 at $9.3 billion, where we believe we are competitive across every one of the key markets that we're trying to do business in. From a return standpoint, we've generated very strong returns in the last decade. We've invested over $12 billion of capital in around 60 transactions. And at least within the KKR world, Asia has delivered the highest returns within private equity in Asia versus the US and Europe in the last decade for us. I don't think we could have ever predicted how quickly the business would scale for us in Asia. But when you think about the scale of the economies that we're addressing, with China, with Japan, India, Indonesia, Australia, Korea, these are some of the largest markets in the world in terms of GDPs. So when you think about a $9 billion fund in that context, it's not that challenging in terms of putting that money to work. I think what's really hard, though, is being disciplined and being flexible and being the partner of choice in this market. Because we're not looking to build market share per se. We want to do a handful of very, very significant transactions in each of these markets and be very disciplined about how we deploy that capital today.
Asia has proved itself, but it hasn't, not all of the impediments have been removed. We still may have currency issues. We still may have government stability issues. We have better access now to exits than we did 30 years ago, so that's good. We have more experience now both in the hands of entrepreneurs and in the hands of general partners of funds than we had 30 years ago. So there are a lot of positives that have occurred, but still Asia is more likely to be perhaps more cyclical than the US, for example, and certain other parts of the world. So that's something we all have to put up with. But even in the US, if you look at the private equity business over 30 or 40 years, it is a cyclical business. And in fact, most investment businesses are cyclical. And so we have to expect that both here and in Asia. It may be subject to different variables in Asia than it is here. But clearly this is a market that is here to stay. And as we all look at China's growth and the potential in China, if we are not all invested in China, we're missing a market that is probably going to be one of the biggest markets in the world, and maybe someday may even eclipse the U.S. private equity market.
Today, the industry, as we look at it, basically mirror what we have seen in the U.S. and then Europe, right? We look at also the measures of data, transactions, and number of players and penetration. We like to compare ourselves with the U.S. and Europe. And I think we're obviously not there yet, so there's still a lot of growth to go. But I think with the emergence of China being a very important market and private equity being very, very vibrant in China, and China is, I think, experimenting with a different model with unique characteristic. I think Asia will go down the same path. We will have more unique Asia characteristic. For example, the participations of sovereign wealth funds, state-related entities, not just at the LP but also at the transactions level. I think that will be a lot more common in Asia than in US and Europe.
We have a significant amount of domestic capital now playing, particularly in China, but elsewhere in the region as well, but particularly in China. And the dynamic there is changing, and it's clearly the case that there's a lot of money, I don't know if trapped in the system is the right word to use, but there's a lot of money staying within China that's looking for things to do, and maybe they're doing things in a different way than what our traditional private equity managers would do. The durations tend to be shorter, they tend to be taking more risk and quite aggressively pricing assets. So I think that's changed a bit. I think that will normalize over time. I believe that anyway. I believe that the kind of capital finds its own level globally, but it may take longer than we expect. And that changes behaviors and it changes expectations.